Hello, everyone. It's Professor Reiko here. Today, we will continue on with our stockholders' equity chapter. In this one, we're still looking at issuing stock in different situations. In this one, we're just looking at non-cash transactions, meaning we issue the stock, but we receive something in return. So we can either receive some other property or asset, or somebody could provide some sort of service in exchange for the stock. Okay, so that means our debit would be something other than cash, either an expense if they're providing something for us that we're expensing as a part of our business, or another asset. All right, so the general rule here is we're going to record at the fair market value of the stock issued, or the fair market value of what we receive, whichever is more clearly determinable. So let's walk through a couple scenarios here. So it says assume we issue 5,000 shares of $7 par common stock, and then the asset we're going to receive is a patent. Okay, so that means my debit in all these examples will be a patent. All right, following scenarios that we are going to consider here. First one, we cannot determine the fair market value of the patent, but the fair market value of the common stock is 50. All right, so before we even really get concerned about numbers here, I mean, we're receiving a patent, we're recording common stock, and look, we're always going to record that at par, so that's going to be 35,000, the 5,000 shares times the $7 par, and then the difference is all going to be captured in our additional paid-in capital, a common stock account, or paid-in capital in excess of par, whatever your book uses. All right, so look, we don't know the fair market value of the patent. However, the stock that we are giving them for the patent is 50,000. So it makes sense that we should put the asset on the book at 50,000, and then additional paid-in capital catches everything else. All right, next example. Scroll down here. The fair market value of the common stock in this situation is known, but we know the value of the patent is 60. Okay, well, if we know the value of the patent is 60, let's just put the patent on the books for 60,000. Common stock, remember, always goes on at par value, so that number is going to stay the same in all of our examples, 35,000. And then additional paid-in capital catches everything else. So in this case, that would be 25,000. All right, last example. We cannot determine the fair market value either, so we do an appraisal, and the appraisal says that the patent is worth 55. Okay, that's all the information we have, so that's what we have to go on. We'll put it on at 55. Our common stock is still always going on at par value. An additional paid-in capital common stock is going to catch everything else, which was 20. Now remember, if any of these examples we've done over the past few videos was no par common stock, then there just wouldn't be any additional paid-in capital. The whole number would go to common stock. Okay. All right, so that's a pretty quick little example here. Our next one will also be pretty quick on issue cost, and then we'll roll into treasury stocks, treasury shares, which is kind of more of like a bigger problem in the chapter. Okay, so this is a quick one. Make sure you tune in next time for stock issue costs, and then we'll get into treasury stock after that. All right, see you next time.